Hi, welcome to the Interaxis YouTube channel, interaxis.io. We're going to go along with our theme now of real-world assets, tokenizing real-world assets, putting those assets and the values of them on-chain, being able to trade them, and we've talked at length about the benefits of taking assets in the real world, whether they be real estate, funds, private companies, all the way to invoices, bonds, debt, anything like that, and putting it on-chain. And once, of course, it's on-chain, once it's tokenized, the relative efficiency, the ease of being able to administer those particular investments, those assets for the investors, for the managers, for the issuers, is vastly improved. And therefore, you can do what we've always wanted to do in DeFi, right? We've wanted to do a lot of, we've talked about it before, disintermediation. So in the traditional finance world, we have so many intermediaries, and we've had to have those intermediaries because we've had to outsource much of the trust, much of the data collection, much of the paperwork, the logistics, the legal aspects, the regulatory aspects. We've had to outsource so much of that to third parties, and of course those third parties have to charge a fee, and there's nothing inherently wrong with that. They're doing a job that has to be done. But what we're saying with decentralized finance now with tokenization is how much of that work can we outsource to code? We've talked about it quite a bit with decentralized finance, right? We've talked about how you can have peer-to-peer loans. If you remember in several of our talks, Adam Adam has money, Ron needs to borrow money. And in the current system, this relationship doesn't scale. If we know each other and he wants to borrow from me, that's great. If we don't know each other, we have to go through an intermediary, which we usually call a bank, right? I put my money in here, I get an interest rate for the bank holding my money. The bank underwrites a loan to Ron. He pays them an interest to borrow the money, which was my money. At some point, that's how the bank gets it, and they get to charge the difference in interest rate plus whatever fees they charge, and they're taking on the role of underwriting and making sure Ron pays. They're also taking on the role of guaranteeing that my money doesn't go away, that I have my money. Of course, they outsource their trust to the federal government, right? So the federal government, in terms of FDIC insurance, ensures that a certain amount of my money will always be there. And as we've seen, the federal government, for whatever they need to do, they will print money if they have to make sure that these banks have the money to give to me. Therefore, the bank is really just doing this, taking on this role of underwriting and getting paid for that. That's really their main role, is underwriting loans, finding good loans, and issuing the money, lending the money to those who need it, and getting paid a level of interest. Okay, now with many of the DeFi products, what we've seen, DeFi protocols, is the ability to take the bank out of it, right, and just be able to create these peer-to-peer lending. So the bank is now a protocol, right, like a Compound or BZX, something like that. The bank is a protocol now in the middle that says my money is going to go in here, it's going to be relatively safe, someone else is going to borrow it, and I'm going to get paid some interest, they're going to pay some interest, and the protocol now is able to stabilize itself and able to determine how much interest to charge, how much interest to give me, and it can do it on a minute-by-minute basis based on supply and demand. So that's what we've seen in terms of disintermediation. So where does tokenization fit in, and where can tokenization fit in with decentralized finance? So keep in mind that many of the assets that are being tokenized, we can talk about them in terms of being real estate. Again, it can be, there are some funds that have been tokenized. It can be, eventually, it can be debt. We've seen art, right? We've seen cars. Where we'll see more bonds, which fits in the role of debt, but It might be in, eventually muni bonds. It might be corporate bonds. It might be private debt that gets tokenized. So what has to happen in order to get this back to DeFi? Well, the whole point of DeFi, potentially, again, is I have my wallet, right? And I might, and I don't have to go through the KYC AML necessarily to have my wallet. Okay, so if from my wallet, my Ethereum funds, in this case, I can maybe choose some of these investments to make, right? So you have all these investments that have now been tokenized. There's a token that represents this real estate or these funds or this debt. Now again, this is all hypothetical. This hasn't, most of this has not happened yet. And I'm going to talk about what some of those issues are in just a moment. But the idea is I have my wallet, I have ETH or DAI or whatever it might be, and I can choose from among all these different opportunities to invest my money. These are all backed by real assets. Okay, so we are no longer in the realm of strictly cryptocurrency anymore. We're no longer in the realm of just cryptocurrencies trading and then liquidity pools on top of that and some other methods of yield farming and some other methods of decentralized debt. Now we're talking about real debt, real bonds, real estate, art, cars, all of that, real assets, and I can now potentially use my decentralized wallet, my Web 3.0 wallet, to connect and buy this. That means I can be pretty much anywhere in the world. Now, that begs a few questions, things like regulation. So potentially what you're going to have in here is some level of KYC AML that says these may all have some regulatory issues, okay? And the regs might say you have to be accredited investor. Okay, maybe I now have to have some sort of token in here that is the accredited investor token. And if I don't have that, well then I'm not able to buy all these. That will probably happen. There'll be some sort of way to judge whether or not I'm an accredited investor, and once I do that, I can now buy into all these. Currently, the way it works is the different platforms, the different platforms that are markets, that are exchanges, are able to trade some of these tokenized assets, do the KYCML, and only allow in the accredited investors. But I see into the future where there will be a wallet feature, a token that says that I'm accredited, and if I have that token in my wallet, I can now go buy all these. So we see that potentially happening, but the idea is maybe I'm anywhere in the world. Well, maybe the regs say you can't buy these if you're in the US, or you can't buy these if you're in the EU or something. There's another token that is a geographic token. Right? Here's where I live, here's where I'm from, here's where I pay my taxes, and therefore because of that I can or cannot participate in some of these. Again, we're keeping in some of those government intermediaries, but because of this, I might not have to go through a certain exchange. I might not have to go through a bank or some other third party, some other intermediary, and that takes out some fees and that takes out some friction. The other nice thing because of this is I can do this 24/7. I might not have to wait to actually purchase all these. It might be Saturday night and I have nothing better to do, and I found this real estate token that I want to buy, and I have some money in my wallet, so I go buy it. What it also means is there might be requirements based on the actual offering documents that say there's certain lockup periods. So people can't necessarily sell these tokens, if they purchase them within 12 months, right? So they have 12 months once they purchase to actually sell them. Well, that can be factored in. So if this token is in my wallet and I want to go sell it, well, I can't do that within 12 months. I can't even offer it up as collateral for a loan within 12 months. So that's some of the ways that DeFi is going to kick in. Now remember, this doesn't have to be necessarily on Ethereum. This could be done on Tezos, for instance, right? Because Tezos has the ability to, very good ability to host these security tokens, have security tokens written on top of it, and also has DeFi capabilities being built right now on top of that particular chain. In addition to that, you have chains like Cosmos that are able to bridge other chains. So we will probably see the ability to have security tokens on Tezos and be able to have DeFi applications on Ethereum and have those two talk to each other. And where we could see that happen is, let's say I own a real estate token that's on the Tezos blockchain, and it's been 13 months since I bought into it, and it's worth, say, $100,000, $100,000, whatever it might be, and I want to get a loan. Well, can I now use this particular security token as collateral on some chain, some peer-to-peer lending, or some lending protocol that I can borrow and use it as collateral? Maybe at some point Compound allows me to use this as collateral to get a loan. Well, that would be great, because then I can offer, say, 50,000 of these tokens as collateral. I can maybe get a 25,000 DAI loan straight into my Ethereum wallet, and maybe this goes to like a debit card or something, and I can pay that way. I can pay for something and never have to sell this. I just use it as collateral. That begs another question. How do we know what these tokens are worth? Okay, this is a really important point and something we need to solve, and we'll talk about this actually in one of our podcasts. But how do we know what these tokens are worth? Well, we have to be able to get data, right? So when we talk about on the Ethereum blockchain especially, and we start talking about DeFi, there's been a lot made about oracles, right? And how important the oracles are, and how important they've been so far in the development of DeFi and the composability. That we need these oracles to inform us as to what the value of the real world assets are. Right? So when we're just talking about DeFi, when we're talking about liquidity pools, when we're talking about decentralized exchanges, we have to know what the value is of those cryptocurrencies all the time, and that's how we can inform the value within the exchange, within the liquidity pool, within the markets, whatever they might be. We have to know what the values are, and sometimes we have to have decentralized oracles like Chainlink and Teller and Band that are able to tell us what the prices are. Well, how are we going to know the price? Where are we going to see price discovery of real world assets? Now that's where we're going to have some sort of data providers that go out there that we trust to be able to get the data. Well, what data is there for these tokens? Because we're not just talking about the price of ETH or the price of some of these tokens. Now we're talking about the real world asset data. Well, how do I know the value of a particular piece of real estate? Well, I have to have some company, somehow we have to ascertain what all goes into the price, what all goes into the value, because what you're going to have is an exchange that's going to list this particular real estate token on it, and if I'm going to sell this particular real estate token, someone else wants to buy it, they want to know what it's worth. Well, what all goes into the value of it? It might be the appraisal of the land. Well, we have to get that data somehow. It might be the occupancy. We have to get that data somehow. It might be the rents that are being paid. It might be the FICO scores or the credit scores of the companies that are actually paying the rent. It might have something to do with geography, what's happening in that particular city or that particular region that is really pertinent to that particular piece of real estate, which would tell me the value of that token, and that can all be wrapped in. And when I go look at that exchange and decide if I want to buy that token when it's on a secondary market, I'm going to have to trust that all this data is accurate so that I can buy it. Well, now you got to have data linked to oracles. Those oracles, again, might be Chainlink or Teller or Band that are able to, in a decentralized way, provide this data. Or maybe this data has been contracted via a third party to provide, straight into this real estate token. Maybe when they launched it, they said, here's where we're going to get our data from. It's this independent third party. They go look at the rent rolls. They go look at how people how companies are paying rent to this particular institutional class real estate. this commercial real estate. They're going to go look at the appraisal values. They're going to look at what's happening in that particular market and help us determine, give us that data, and from that data we'll be able to price this real estate token. They're going to go look at this data and help us price this debt, because they're going to look at default rates, they're going to look at credit scores, they're going to look at, again, at whatever industry is dealing with this debt or these bonds. We're really going to have to find data to inform this, because again, since this is going to happen in a decentralized way, in a way that it's peer-to-peer, I don't necessarily know the person I'm transacting with. We're going through an exchange. These kinds of assets, real estate like this, private real estate, private debt, groups of bonds and stuff, a lot of that has not always been traded. Bonds are a little bit easier. Debt is a little trickier, because yes, it can be securitized and packaged, but the information within some of those securities, the information on the individual debt offerings, is data that we just have to plug in there. And once the data is in there, then I can run my metrics and decide what it's worth to me. So some of these are assets that have not been traded in a decentralized way before. They've only been traded either able to be redeemed directly to a company, or they're not able to be traded at all. So we're going to have to find new ways to analyze the information, analyze the data, and figure out what the valuations are, figure out how we arrive at our price. So these are just some issues of how tokenization and DeFi will kind of work together when we start to get real world assets and we want to be able to use them as collateral for loans. We want to be able to trade them in a decentralized way. We want to be able to see them show up in our wallets so that they can show up in our overall reporting, in our overall portfolio. That's not just our DeFi portfolio, but our overall portfolio. We want to be able to see those in the wallets. We want to be able to take these real estate tokens and maybe get a loan against them and see the DAI show up. But we also have to have this other token that says that we're a accredited investor, or that we live in the US, or we live in the EU, or wherever it might be. So this is how Web3, this is how decentralized assets, decentralized finance, and tokenized real world assets are going to start to fit together. This is what we see. We might also see something like a Melon protocol or a set protocol or something be able to give us the ability to build portfolios that include some of these tokens now. Well, of course, that has to rely on this data informing the value of these tokens, but I might be able to use something like set protocol or Melon protocol to create a fund or create a token that includes certain real estate, certain debt, as we've said before, certain hedges in there, because we say we want to buy real estate in Texas, but we want to hedge against the price of oil or something. We can have all of that inside some sort of robo tool like a set protocol, or some sort of fund like Melon can help us create, and look at it in a very decentralized way. If we go to something like Melon, where I'm raising a fund and I want the transparency of what I'm investing in, I want to show my investors what I'm investing in, then I need to show the transparency eventually of these real estate funds, or these debt funds, or these bonds, or whatever it is, and I'm going to have to show the data there. So this is where DeFi and the tokenization of real world assets are going to start to work together. And this is where we're going to see it, because eventually DeFi can't just be cryptocurrencies that are traded back and forth. It can't only be lending and borrowing from each other. That's a huge part, but that lending and borrowing eventually has to be based on some sort of collateralization and some sort of real world assets. And then even those loans, even groups of those loans, buckets of those loans, are going to get securitized. They're going to get put together, and that will probably be tokenized. So if I make a whole bunch of loans to people based on their real estate tokens, then I can package up those loans, again, in a decentralized way, form my own token, and then sell that to someone who's looking for that level of income. Well, they're going to get unbelievable transparency into that data, because they're going to see all the loans I've made and all the real estate tokens that loan is using as collateral. Unbelievable amounts of of trust and unbelievable amounts of transparency that we've never seen before in the securitization of assets. So it's really an exciting time when we start talking about tokenization, but that, to take a few steps back, is why there is so much regulation that still has to be in place, why there is so much custody that still has to be built, and kind of insurance on that custody. The technology has to be there. We can't have hacks of these kinds of smart contracts. We can't have people losing their money, because now we're talking about real assets, and we have to kind of do it right. But once we do, it is going to explode the ability for so many more people in the world to participate in all these different aspects of finance that were only previously available to the very, very wealthy, the super rich, the hedge funds, the institutions. It's going to democratize that, we think, because we're going to give so much more transparency and so much more data and so many more asset classes that they can invest in. But first, we need to get that regulation there. We need to get that straight. We need to get the custody straight. And then this is what's going to happen. This is what we're really excited about. This is why we've been talking about this for a week or two, about the tokenization of real-world assets. So we hope you like this video. We hope you appreciate our enthusiasm for this. Please subscribe to the YouTube channel. Check us out at our website, interaxis.io. info@interaxis.io is the email address. And of course on Twitter @interaxis8, number 8. We hope to see you there.